Right, it's Joe. So I'm just going to take you through some of the capital transactions in a company as far as issuing of shares for cash or for other consideration. And we're going to work through a number of exercises. So this first video is on issuing shares for other consideration. So Tania Limited is a company. It's incorporated with a constitution that allows it to issue ordinary and preference shares. And on the 1st of April, it decides to buy a business of K Martin, his business Star Plus. They've worked out the fair value of the assets, and based on that, the fair value of the assets, which is a net figure, it's the land, motor vehicles, inventory, plant, accounts receivable. You see there's a figure that in the books it's 95,000, but they're going to make an allowance for doubtful debts. Okay, so they're giving it a value of 85,500. They offset what the business owes, or it's their accounts payable, and it says that the fair value is $770,000. They're willing to pay some goodwill, so that they're willing to pay 850,000. So the difference between 850 and the 770 will be goodwill. So we can work that out over here. So first we want to do a journal to bring in the purchase of the business. Okay, so let's not get too strung up. Let's do one thing at a time. Let's bring in the business and then let's look at the consideration second. Right, so that's just to confirm my calculation over here. The assets were 770, which we picked up from here. We're offering 850. The difference between the two is goodwill. All right, so that's just a calculation. All right, then we want to journal in the assets. All right, so really it's a matter of bringing in the assets that we've purchased. So we know the values. It's pretty straightforward. We just pick up those values. Assets are debited. All right, so we just need to bring those in. All right, okay. So you can see I've picked up those figures here. I've actually picked up the 95, not the 85, because we are going to make that allowance. All right, so that allowance there will bring that down to that. The reason we bring it in as a full value is because obviously we're going to chase the $95,000 worth of accounts receivable. Even though we're entering it as a journal here, those would all be sort of individually entered in the accounts receivable ledger so that we could chase them, right? Okay, we can now put in that figure there, which is the goodwill which we worked out. Okay, all right, so that's fine. So that's bringing in the assets. There's also another liability to bring in, which would be that figure there, which was the accounts payable. So we've brought in the assets and the liabilities, and at the end of the day, what we do is we owe K Martin $850,000. So that's a journal entry to bring in the purchase of the business. Right, half the job done. Okay, so the next thing is that the second thing we need to record is the consideration, because what we're going to do is we're going to issue some shares. All right, so I've done some calculations over here, which I'll now make visible. So what we said is we'll give you ordinary shares, which are valued at 90 cents. So we're going to give you $540,000 worth of ordinary shares. We're going to give you 50,000 preference shares, which are valued at $1.20. So we're going to give you that amount of shares, which adds up to 600,000. Okay, right, so that's pretty straightforward. So we know that we're going to give you some shares, plus we're going to actually give in the balance, okay, is going to be the difference between the share value and the 850. Okay, so it's relatively straightforward. Okay, so basically we're going to end up owing K Martin $250. All right. Okay, so we bring that journal in. Okay, so we just need to K Martin. Okay, we've already recognised we owe him $850. Okay, so basically we reverse that out, and we reverse that out by giving him some ordinary shares to the value of 540. We give him some preference shares to the value of 60,000, and then we acknowledge we owe him still a loan, and then we recognise it as a loan. All right, so that is how we've accounted for the issue of shares for other consideration, and that was the purchase of a business. So that's that one completed.